Swonk, KPMG chief economist, joins us here on set. Diane, good to see you.
Good to be here.
So let's just, I guess, define our terms here, what we're looking for in the way of stagflation. I guess, essentially risks on both the growth and the inflation side that might keep the Fed static for a while.
Exactly. So the economy is slowing. There's no question about that. And in fact, the drag from government spending, we know that cuts to social programs and transfers to nonprofits, contracts, all of that ripples through the overall economy. That's dampening growth. At the same time, tariffs squeeze profit margins, but so much so they have to pass some on to consumers. We know in 2018 and 2019, all of the tariffs are passed on to consumers. The magnitude and breadth of what we're talking about just can't be. So you get this odd combination of a creeping up unemployment rate and an elevated inflation. We have inflation peaking out in the second quarter at 4.1% annualized pace. That's not, anything like what we saw during the blistering inflation right after the pandemic. But while the embers of inflation are still smoldering, that's something the Fed has to be worried about. And those higher inflation levels and the layered and compounding effects of these tariffs, that keeps the Fed on the sidelines throughout the latter half of 2025 and not really cutting until 2026.
How will tomorrow's CPI number, if at all, filter into this? It seems like there's an opportunity for the market to find some relief if it's a benign number, but maybe
it's kind of backward looking. Yeah, it doesn't have any of the tariffs in it yet, although there was front running, and we've seen everything from steel prices, aluminum, lumber, all pick up in anticipation of tariffs. We've also seen trade imports of those goods soar in anticipation of tariffs, trying to stock up ahead of it, but that was its own self-fulfilling prophecy. What the Fed's also worried about is this time around we had this muscle memory, and you saw it in the NFIB index as well. We recently raised prices. In the 2010s, we not only had well-anchored inflation expectations, they were set in cement. Now we've been through a period where not only do consumers expect some level of inflation, but we saw in the NFIB index that actually the highest number of small businesses are raising prices already, and that is something they didn't do in the past.
So that's
since 2021.
Right. Now you're getting to one of the big arguments that the administration likes to give, and that is tariffs didn't create any massive inflation in our first administration. You think the calculus regarding pricing has changed? Was that a COVID?
That's one is the context is different, but two, the speed and magnitude of these tariffs. The effective tariff rate back in 2018 and 2019 popped up to about 3.25%. We're talking about conservatively on our baseline, with not everything that's been announced and some, scaling back, 16.5%.
I've seen some adverse 25s.
Our downside scenario has 25 on the effective rate, and that is working with our own tariffs and custom people internally. That is remarkably big difference. And it also, because it comes unevenly and sequentially, and they add on to each other. In fact, some of the steel tariffs coming in from China, could not only get a 25% tariff and another 25% tariff, and then you add on to that an additional 10% and 10%, that's 70%, and that you could accumulate it over the course by spring. That's a lot.
Given all of that, how would you handicap the likelihood of stagflation? And if so, what do you think that means for certain asset classes?
Well, clearly we're more worried about stagflation than we are about other scenarios out there. People looking for the Fed to cut as soon as June. We think that's hard for the Fed, even as the economy slows. The hardest part for this is the manufacturing sector. On one side of it, the steel industry gets protected. We know in 2018 and 2019, they actually added jobs, but no capacity in response to the protections they got. Those job gains were more than offset by the higher input costs that manufacturing was struggling with, and the losses in manufacturing employment overall. And I think that's where you see it the most, is in the goods sector, but you're also seeing it in the tech sector. This really goes across asset classes, even restaurants, looking at the amount that they import in terms of food and all their utensils. We're talking about even taxing the kitchen sink here. The stainless steel sinks are going to be taxed at a 25% rate coming into this country.
Yeah, it's a lot of friction thrown at this economy. Diane, thanks a lot.